What up, guys? And of course, welcome back to another video. It's your boy Jay Manchin here, and I know you've been hearing a lot of talk about the housing market as dynamics have been shifting hard lately.
Higher interest rates and throw in just some broader economic uncertainty. Together, that is weighing on the housing market, and it is finally starting to hit home prices. Diane Olick is here with the bad news.
Are we going to experience a collapse in the housing market, or is this just a normalization because prices have been up over the past 5 years, 50%? Well, let's explore together. Now, you might have seen this headline from Redfin. There are now 500,000 more sellers than there are buyers on the market. And it's a record for that data point. And there are also only 7 markets in which you can buy a luxury home under $1 million. How did we get here? Well, we got to go all the way back to the Great Recession of 2008. ZIRP, or zero interest rate policy. Now, I've done a video on this in the past, so if you want a lot more detail on this, you can just go check this video out. I did it a long time ago. Maybe 2 years ago. So just as a refresher, inflation numbers were negative 2.1%. Unemployment was all the way up at 10%. And GDP was contracting about 2%. So in response to that, during the fallout of the Great Recession, the Federal Reserve decided to take interest rates all the way down to the zero bound. The federal funds rate went all the way to the zero bound, effectively between 0 and 0.25, which means the cost of capital was effectively zero. And the hopes were that it would spur on economic activity, increase investment, and increase lending, / keep money flowing through the financial system. And over the next decade following the Great Recession, they attempted to normalize rates eventually. Fast forward to 2020, during COVID, the Fed takes the Fed funds rate all the way back to the zero bound again. And now you combine that with fiscal stimulus, the largest fiscal stimulus in history, then you have inflation numbers eventually hitting 9% during that type of environment. And of course, the housing market was going insane. Buyers and investors, of course, it's a no-brainer to take advantage of literally historically low rates, the lowest we've ever seen, ever. In 2021, the average rate on a 30-year fix was sitting at about 2.6, 2.7%. Now, the average on a 30-year fix is sitting at 6.8, 6.9%. And to put that in perspective, that's the difference between $900 a month payment on a 2.7% interest rate on a $400,000 house versus a $2,600 payment at a 6.9% interest rate. So understandably so, the market was on fire. And of course this exacerbated investor demand because money was so cheap to borrow. And by the time you're done with the rehab and then you list it, and this is a flip, and you list it on the MLS, you can bet that there was probably some appreciation in the price or in the value of the home. And so it was a no-brainer to buy as much as you can and feel that appetite. And this also exacerbated the rise of iBuyers like Zillow and Opendoor and other institutions because of course they wanted to cash in on the lowest interest rates in history while home prices were headed to the moon. But we all know how that's going / ending. Not good. And it caused a mass exodus as during this time, remote work was becoming more popular. With logic being interest rates are super low, I still make good money, and I can work from anywhere with this job. It was the easy choice. And while we're experiencing asset inflation all across the board, of course, home prices kept going to the moon. And this is part of the reason a 30-year mortgage is one of maybe the best inflation hedge. Now, fast forward a little bit to the Fed rate hiking cycle of 2022. In March 2022, the Fed funds rate set at the zero bound or 0.2%. And by May 2023, the Fed funds rate had already hit 5%. And of course, this was a huge shock to the housing market and things slowed dramatically in real time. And it also caused mortgage rate lock-in. With the logic being, why would I trade in my historically low interest rate for something way higher, especially if my life hasn't even changed that much financially? And this ran rampant across the US because, homes were getting more expensive, the cost to maintain the home was getting more expensive, and pretty much everything else in life during that time was becoming more expensive. And so it made sense for most people to stay put where they were. Now, fast forward to today. The average payment on a 30-year fix is sitting around $2,700 monthly payment. Cancellation rates are increasing, 14% nationally. That's 1 out of 7 homes. So that's every 1 out of 7 homes, the contract is being canceled. Both pending and existing home sales declined in April, and inventory has been increasing. Nationally, we're sitting at about 4.5 months. Existing home sales were sitting at about 4.5 months, and new homes were sitting at about 8 months. And where I am in Vegas, we're sitting at almost 4 months worth of inventory right now. And so inventory is increasing, but still that's from historically low levels of inventory. So let's just keep that in mind. And demand has definitely slowed over the past few years, but still healthy and steady enough to keep things moving and prices going in the upward direction from here for the most part. Now, prices nationally were up 2% in April, but that is the national picture. Let's dive in a little bit to that because obviously it's market by market. Now, we got about 300 markets in the US, and 42% of them in April recorded price declines. Now, you can see the majority of the markets that have experienced price declines are in Texas and in Florida. And of course, you got Phoenix and Colorado, and you got some other markets on there too. But for the most part, these price declines have been pretty concentrated. And that's important to look at because when you hear 42 markets around the US have reported price declines, you get a picture in your head and you think that that's some type of barometer moving forward for the rest of the US. And I would say it is just not. I mean, the top 5 largest reported declines were in Florida. Now, as we talked about in my last video, the Federal Reserve has pointed out that home prices they felt were too high. And it seems like they were implying that prices should or will fall. And they can't lower rates right now in the context of housing because that would just put upward pressure on home prices. So the housing market needs to find a neutral way to fall back to its equilibrium without having a huge shock and without making unaffordability way worse. And I think that's where we are now, to be honest. The market needs to understand that 3% mortgage rates aren't coming back anytime soon, at least. Now, the one thing that could happen is that Donald Trump just brings in somebody who's extremely dovish or going to do exactly what he says in terms of monetary policy after Jerome Powell's term is up in May. And he brings, let's say, Scott Bessent in as the temporary chairman of the Federal Reserve. Then he takes interest rates significantly lower. I mean, that is a possibility right now, so that could happen. But we'll see. Barring that, 3%, 4% mortgage rates aren't coming back anytime soon. Now, where do we go from here? Zillow is expecting a 1.4% price decline in national home prices. Redfin is expecting a 1% decline in home prices by the end of the year nationally. And Fannie Mae is expecting prices to continue to move up. Now, of course, the price declines that we just went over earlier are not national. Nationally, things are looking a bit more gradual. And of course, it's just market by market. There are going to be some markets that experience a technical collapse. There are other markets that are going to experience just small corrections, and others are going to remain stable. So I think this is a good opportunity for the housing market to gradually soften in home prices, while some markets will experience more animated price declines. But I do not think we're headed into a housing crash. I think prices will soften to a point which causes demand to pick back up, and it brings some type of stability to the market. And that's, of course, barring any black swan event. Make sure you subscribe, comment, like the video. Thanks for watching, and I'll see you on the next one.